The S&P continues to trade right near all-time highs, and it seems like it will not stop going up. This is leaving many investors wondering if they should continue to buy stocks, build cash, or even sell out of the market. Now, every 3 months, JP Morgan also puts out their Guide to the Markets, which is an in-depth presentation that shows the current price of the market, consumer health, expected future returns, and much more. And just a couple of weeks ago, JP Morgan put out their Q3 updated presentation, and in today's video, I want to go through the highlights of this presentation with you. I will also be sharing my views on the market today, what I am personally doing in my portfolio, and if I am building cash. So with that being said, let's hop right into the video. Alright, so here we have the first slide of the presentation, and we can see that as of September 30th, 2024, the forward price to earnings ratio of the S&P 500 was sitting at 21.5x. Now, what's interesting to me is the peak of the stock market on January 3rd of 2022, right before that massive 25% correction happened, the market was trading for a forward price to earnings ratio of 21.4. So what's interesting to me is as of September 30th, the market was trading for a higher price to earnings ratio than when the market topped in 2022. And this is interesting to me because I did believe the market was quite expensive before that correction happened. And now the market is actually even more expensive. Now, JP Morgan also shows us the forward price to earnings ratio of the S&P during the tech bubble, and it was sitting at 25.2. So the stock market today isn't quite at the tech bubble levels, and we're about 20% off still, but I do still believe that the S&P 500 in general is looking quite expensive right now. Now, in this next slide, we can see that the 30-year average forward price to earnings ratio of the S&P is 16.73. And again, the market is currently trading for about 21.52, which is about 50% above the 30-year historical average. So the S&P is trading well above its historical average price ratios as well. If we take a look, we can also see that there was only 2 times in the past 30 years where the market was trading for this expensive of a price. And that was during 2021 to 2022, as we recently discussed, and back here during the tech bubble. So there was literally only 2 periods in the past 30 years where the S&P was trading for multiples this high. And this is kind of what's causing me to believe that the S&P is very expensive today. Moving on to the next slide, this shows some of my favorite charts in the entire presentation. So this first chart on the left-hand side shows us the historical 1-year returns after the market has traded for a 21.5 forward price to earnings ratio. And we can see that historically, the average 1-year returns are basically 0%. Now on the right, we have the 5-year annualized returns. And we can see that historically, when the market has been this expensive, the 5-year annualized returns have been about 3%. Now, ultimately, what this tells us is, one, that the more expensive the market becomes, the lower future returns investors should expect. And when you think about it, this has to be the case because the higher prices you pay, the lower future returns you should expect from any investment. And the second conclusion that we can gain from these charts is that investors should be lowering their expectations for future returns from the overall S&P. Because again, historically, when the market has been this expensive, its 5-year annualized returns have been quite low. So I think that all investors should be lowering their expectations today. And that's what I'm personally doing in my own portfolio as well. All right, moving on to the next slide. This shows us the earnings per share projections for the S&P, or basically what analysts are thinking for the S&P's future earnings growth. And we can see that in 2025, they are expecting about 15% growth, and then in 2026, they are expecting about 12% growth. Now, how I view this as an investor in the market is that analysts are pretty bullish on the future of the S&P and the earnings growth. And if I am someone who is not as bullish, then I can also kind of temper my expectations because the market is probably pricing in pretty strong growth to earnings over the next couple of years. All right, moving on to the next chart. This one shows us the relationship between the valuations of growth versus value stocks in the S&P. And we can see that value is currently considered cheap relative to growth. However, value stocks are currently trading at a forward price to earnings ratio of 16.7 versus their long-term average of 14.1. So even though value stocks are quite a bit cheaper than growth stocks right now, they are still selling above their long-term historical averages, and therefore they could still be considered quite expensive today. Moving on, this chart on the left-hand side shows us the price to earnings ratio of the top 10 stocks in the market, the remaining stocks, and then the S&P 500. And here we can see that the top 10 stocks are currently trading for a forward price to earnings ratio of 30.5 versus their long-term average of 20.5. So they are trading about 50% above their long-term historical averages. The remaining stocks in the S&P are trading for about 17% above their historical averages, and in general, the S&P is trading about 30% above its historical average price-to-earnings ratios. They also show us a chart of the weight of the top 10 stocks in the S&P 500, and currently they are sitting at about 36%, which is the highest concentration of the top 10 stocks over the past 30 years by far. And the concentration seems like it is continuing to just go up. So the S&P 500 is becoming more and more concentrated in a handful of stocks, and it's not really that diversified. Well, not nearly as diversified as it was historically. However, this next chart shows us that the Magnificent 7 earnings growth is projected to be quite a bit higher than the S&P 500 excluding the Magnificent 7. So it does make sense that the Magnificent 7 has a higher concentration of the S&P because they are expected to grow at significantly higher rates. Additionally, the Magnificent 7 profit margins are significantly higher than the rest of the S&P. In fact, they're almost 3 times as high, sitting at 23.5%. So these businesses are much more profitable and they are growing significantly faster than the S&P 500 on average. So again, I do think that there is some justification for these companies making up a larger and larger portion of the S&P. But in general, they are still looking very expensive today. All right, now this next chart gets into the consumer health today. And this is the household debt service ratio. And we can see that it is currently sitting at 10.1% versus about 13.3% right before the Great Recession happened. So the household debt service ratio is still quite a bit lower than historical averages and lower than it was right before the Great Recession happened. However, flows into early delinquencies are trending up in a pretty big way, especially for auto and credit card loans. Student loans are basically at an all-time low over the past 20 years at 0.9%. However, credit card early delinquencies are trending up and are now at 9.1%, and auto loans are sitting at 8% now, and they do look like they are above their historical averages. And this is something to monitor and pay attention to because it's quite clear that auto loans and credit card debt is starting to go bad. All right, moving on. This next chart shows us the capex from the major AI hyperscalers, which are Alphabet, Amazon, AWS, Meta, Microsoft, and Oracle. And we can see that in 2024, these companies are projected to spend $192 billion on AI. In 2025, it is projected to grow to $218 billion, and then in 2026, it is projected to grow even more to $237 billion. Now, to put this in perspective, this is roughly 40% of these companies' operating cash flows going into AI capital expenditures. So basically, JP Morgan is projecting these companies to continue spending more and more money building out their data centers and their AI, and it looks like this is going to continue trending up. So these businesses' profitabilities are probably going to be suppressed for the next 3 years if these projections do come true. Moving on, this chart shows us the contributors to headline CPI inflation. And we can see that inflation is clearly continuing to trend down, and most recently it was at 2.5%, and the Fed seems like they are actually doing a pretty dang good job. The number one contributor to inflation is also shelter, which actually did trend up month over month, but overall inflation does seem like it is continuing to come down, and this is why the Fed is able to start lowering interest rates. Because lower interest rates typically do increase inflation. So the Fed wanted to see inflation coming down before they lower interest rates because they didn't want this trend to start going up again. So this is something to definitely watch, and this is kind of suggesting that the Fed may be able to continue lowering interest rates going forward. All right, this next chart is the US electricity generation over the past about 24 years now. So we can see that from 2001 to 2009, the US electricity generation was growing. Then it kind of flatlined all the way to about 2019, and now it is growing once again, and it is projected to continue growing out to 2025. So the US is generating more electricity, and it looks like electricity demand is continuing to grow. JP Morgan then shows us that the US electricity demand from data centers is projected to grow by about 30% from 2022 to 2026 to 260 terawatt hours, or about 6% of the US total electricity demand. So data center electricity demand is projected to continue growing significantly in the United States. And I don't know if you guys have been paying attention to the news lately, but the AI hyperscalers like Google, Amazon, Microsoft, and Meta are now buying electricity from nuclear power plants, and they're looking to build and fund more nuclear power generation. because the world is finally getting to a point where they're realizing we cannot scale AI and meet our carbon neutral goals if we do not build more nuclear. So it seems like the world is finally becoming more bullish on nuclear, and the nuclear industry could take off over the coming decades if the electricity demand is continuing to grow. All right, now this next chart is the federal funds rate expectations. So we can see that the Fed has officially started lowering interest rates, and now they are at 4.88%. And by the end of the year, it is expected that the Fed funds rate will drop to 4.4%. And the market is actually expecting 4.16% now. Now, by the end of 2025, the Fed is expecting interest rates to be about 3.4%, but the market is expecting about 3%. And then they are expecting the interest rates to remain at 3% from then on. So basically, in 2025, the market is expecting that the Fed will continue to lower interest rates, and then they will kind of stop being lowered by the end of next year. All right, this next chart shows us the international price to earnings ratio discount versus the United States market. And here we can see that the international markets are trading for their lowest relative price to the US in 20 years now, by far, trading for about a 36% discount to the US markets. And this suggests that the US markets are very expensive, especially relative to the rest of the world. And it seems like investors have piled their capital into the US markets and kind of just been extremely bullish over there, probably because the US markets and the US companies have continued to grow very well, but it seems like it's kind of overdone in my opinion. And now, investors can probably find a lot more value outside of the US markets and in the international markets. And this is something that I have personally found in my own portfolios, and I have recently made a video for my Patreon members discussing this in depth as to why I am not buying as many US stocks lately, and I am buying a lot more international companies. And it's partly due to the fact that the US markets, relative to the international markets, are extremely expensive. In fact, in this next slide, we can see the international forward price to earnings ratios versus their long-term historical averages versus the US. And again, we can see that the US is trading well above its long-term historical average. Japan is actually trading well below its long-term historical averages. Europe is trading for about averages, the emerging markets are trading for about averages as well, and China is trading well below its historical averages. So basically, the US is a very expensive market right now, Japan is actually looking quite cheap, and China is looking very cheap, which I have been saying for quite some time here on my channel. Moving on, this next chart shows us the S&P 500 returns around the start of the Fed cutting cycles. So here we can see the first cut historically that the Fed has made in 1995 to 2019, 1984, 1989, 2007, and 2001. So basically, this chart is showing us the historical performance of the S&P 500 after the Fed first started cutting interest rates. And we can see that in 2007 and 2001, 2 years after the first interest rate cut, the markets were actually down. However, in 1989, 1984, 2019, and 1995, the market was up after the Fed cut interest rates. In my opinion, there's not a lot of conclusions that we can gain from this chart right here, actually. It pretty much just tells us that it's not guaranteed that the market is going to crash or the market is going to rise just because the Fed is cutting interest rates. In my opinion, I think the market is probably going to be flat or trend down because I think the market is just very expensive right now. But that doesn't mean that the market is going to for sure crash or for sure continue to go up. It looks like it's kind of just a flip of a coin as to what is going to happen. And as Warren Buffett says, it's really just a waste of time to try and predict what the price of the S&P 500 is going to do in the short term. I strongly believe that, and I think that this chart right here actually backs up that it's just anyone's guess. This next chart shows us the S&P 500's price to earnings ratio on a trailing 12 months basis. So quite literally just the price to earnings ratio all the way back to the 1800s, okay? Now today, the price to earnings ratio of the S&P is sitting at 29.93. And if we take a look throughout the last literally 140 years, there's only been a few times where the market has been this expensive. It's also worth noting that this brief period in 2020 was due to the S&P's earnings actually falling. So when the earnings fall, if the price does not fall with earnings, then that causes the price to earnings ratio to skyrocket artificially very quickly. In other words, this spike right here in 2020 was due to the earnings of the S&P actually falling. And this was the exact same story in 2008. So basically, the only other times where the market was truly this expensive was during the tech bubble in 2000. And this, again, is why I continue to say that the market is very expensive right now. And I think that investors should be lowering their expectations for future returns from where the market is today. I also am noticing in my own portfolio that it is becoming more and more challenging to find value in the stock markets, especially in the US markets, as I have said earlier on in this video. I did discuss this with my Patreon members recently, but there's only about 3 stocks left in my portfolio that I believe are truly undervalued, and the rest I think are either overvalued or selling for fair value, and therefore it is becoming more challenging for me to deploy capital in the markets and in my own portfolios. Because think about it, if there's only 2 to 3 stocks that are undervalued in my portfolio, and I just continue plowing more and more cash into these stocks, then they're going to become a very large portion of my portfolio. And these are stocks that I don't necessarily want to have 25% of my net worth in, right? So I am kind of getting to a stage in my portfolio where it might make sense to start building cash. I am still buying stocks. I don't have a huge cash position. I'm about 2% cash right now, which I am actually quite happy with because I don't think my portfolio in general is very overvalued. But it is getting to that point, where it's getting more challenging to deploy capital. I don't want to continue deploying capital into these specific stocks that I have that I think are undervalued because, again, I don't want them to become 25% of my portfolio. And therefore, it might be the time for me to start building cash quite soon. Not quite there, but I will let everyone know if I do get there. And it all really comes down to the fact that stocks are looking pretty damn expensive right now. And when stocks get expensive, I don't just want to continue buying for the sake of buying and deploying cash. I do want to make sure that the stocks that I am buying, I am also happy with their valuations. And I'm not really happy with a lot of stock valuations in the market today. All right, now moving on to the last chart that I want to show you guys. This one comes from Yardeni Research. And this is the forward price to earnings ratio of the S&P 500 large caps, S&P 400 mid caps, and S&P 600 small caps. And we can clearly see that large caps are definitely expensive today, pretty much as expensive as they were in 2021 before the massive correction happened, and as expensive as they were in 2001 during the tech bubble. However, we can see that the mid and small cap stocks are trading for a significant discount to the S&P large caps. So there could still be value in the mid and small cap stocks. And personally, I have been buying a lot more mid and small cap stocks. Some of my largest positions now are actually smaller cap companies, and some of my largest gains are in these companies as well. These valuations are starting to trend upward though, as we can clearly see. They're not nearly as cheap as they were in 2022, and even at the end of 2023, but they are still potentially offering more value than the overall S&P 500 large caps. So if you are someone who is an individual stock investor, or you want to try and find some value stocks, then maybe it's worth looking at mid and small cap companies still. But with all that being said, that is going to wrap up the video for today, everyone. And my main conclusion is that the S&P is looking quite expensive. It is becoming more challenging to find value. And I do think that investors should lower their expectations for future returns, because the massive returns that we have seen over the past about 18 months, in my opinion, is unsustainable. It will not last. And therefore, we shouldn't expect 20% annual returns going forward. I think that's pretty unwise. And if you are expecting that, then you're probably going to be disappointed and probably get emotional in your portfolio over the coming years. So I think everyone should lower their expectations. Personally, I am as well in my own portfolios. And that's kind of what I'm thinking for the future. But again, that is going to wrap up the video for today, everyone. And if you did enjoy this video, then please remember to leave a like on it. And I would love to hear your thoughts and your comments down in the comment section below. Also, if you're new here and you want to stick around and see more stock market related content like this, then please consider subscribing to my channel as well, because that would be pretty awesome. And lastly, if you do want to see my full portfolio and get access to all of my buys and sells, gain access to my Discord, and even more content from me about my thoughts on the market, how stocks are being valued, and what I am buying, then you can consider joining my Patreon. It's only $10 a month, and you get exclusive content from me and all of the other things that I just mentioned. It's also a great way to support my channel and all of my content. So seriously, go and check out my Patreon if you want to just get more content from me and support my channel. But with all that being said, that's actually going to wrap up the video for today, everyone. So thank you all again so much for tuning in. As always, I truly do appreciate it, and I really hope to see you all again in my next video.